Insurance. Everything you need to know. How it works and what it does. Insurance comes in different forms, and the key to finding the policy that fits one's needs is understanding the type and level of coverage each one provides. Insurance serves as a financial cushion in the event something bad happens to the insured person, also referred to as the policyholder, and their assets. Insurance as a form of coverage by contract whereby one party undertakes to indemnify or guarantee another against loss by a specified contingency or peril. Or in other words, insurance is a written contract between a person and the insurance company that puts the responsibility of paying for losses that the insured incurs on the insurer. This is given that the incident is specified as a covered event and the policyholder meets regular payments. In the event a fire destroys a house, for example, home insurance will cover for the costs to repair and rebuild the property. If a person causes a vehicular accident, meanwhile, auto insurance can pay out for medical bills and third-party property damage resulting from the collision. If a policyholder dies, their loved ones can receive a financial benefit through their life insurance plan. But what's paradoxical about insurance is that people are paying for something that they are hoping they would never use. Skipping coverage, however, risks putting them and their family in dire financial straits should an unfortunate event occur. How insurance works varies significantly, depending on the policy and insurance provider. Regardless, all policies come with four main components that policyholders need to be aware of to ensure that they are getting the right coverage. These are premium, how much they need to pay for coverage. Policy term, how long the policy lasts. Policy limit, the maximum amount the policy will pay out for a covered peril. Deductible, the amount the policyholder needs to pay out of pocket before the policy kicks in. When purchasing an insurance policy, the first step a person needs to take is to apply and get approved. As part of this process, insurers evaluate how much risk they bring, meaning the likelihood that they will make a claim. From this, insurance providers calculate how much policyholders need to pay for coverage. This amount is called the premium. Once approved, the policyholder will need to make payments regularly. Insurers often give the insureds the option to pay on a monthly, quarterly, semi-annual, or a yearly basis. It is crucial that they meet regular premium payments, as failure to do so may affect their eligibility come renewal time or even void their coverage. Once the policy is active, it will remain in force for a set period, called the policy term. At the end of the term, policyholders usually have two choices. Renew the policy with their current insurance provider. Purchase a new one from another insurance company. Many policyholders also use the second option to get cheaper rates, but that's not the only way to save on auto insurance premiums, among other insurance types. If they experience a covered event during the policy term, they will need to file a claim to notify the insurance company about what happened and provide documentation as proof. The insurer will then investigate to determine the validity of the claim, and if it is, the provider will pay out for the losses. The policy limit of an insurance plan refers to the maximum amount the insurer will pay out for specific claims. It is often listed on the policy documents declaration page, which outlines the key details of the insurance contract. In some policies, policyholders are allowed to choose a limit. Others follow the requirements imposed by the government or an industry body. Higher maximums also result in more expensive premiums. If a claim exceeds the policy limit, the insured may have to cover the additional expenses on their own. What is a deductible and how does it work? A deductible is the amount that the policyholder must shoulder before the insurance company pays out a claim. Depending on the type of policy, deductibles can apply per policy or per claim. Insurers typically impose deductibles to avoid having to reimburse a barrage of small and low-value claims. Policies with high deductibles often have lower premiums. Some industry insiders also suggest policyholders choose higher deductibles to save on insurance costs, but caution that the amount must be set at a level that they can afford to pay. Individuals and businesses searching for some form of financial protection can choose from a diverse range of insurance policies, with each catering to different clients' unique set of coverage needs. This section details what the most popular types of insurance available in the market cover. Auto insurance. To operate a vehicle, it is almost always mandatory to carry car insurance. Auto insurance is designed to protect motorists against financial losses in the event of accidents or theft. It does so by providing the following coverages. Bodily injury liability. Covers injuries the driver causes another person and legal fees if they are sued over the accident. Property damage liability. Pays out if a vehicle damages another person's property and legal defense costs incurred in a lawsuit. Underinsured motorist UIM coverage. Covers medical expenses incurred when the driver or passengers of a vehicle are hit by someone whose policy is not enough to cover all the costs. There are a number of factors which go into choosing which type of insurance is required, often coming down to legislation in different countries and even in different provinces and states within those countries. Home insurance. Home insurance, also referred to as homeowners insurance, is not required by the law. Most lenders, however, set it as a condition for taking out a mortgage. Homeowners insurance may work differently depending on several factors, including where the house is located, but most offer the following coverages. Property damage. Pays out for any physical damage or loss to the house and other structures within the property's premises, such as sheds, garages, and fences, if this was caused by a covered peril, which can include fire, wind, hail, or vandalism. Personal property. Covers personal possessions such as clothing, smartphones, furniture, jewelry, and other household items that were damaged or lost due to specified perils. Medical payments. Often grouped with liability. This coverage pays out for injuries sustained by guests while on the property, regardless of who is at fault. Health insurance. Health insurance policies are aimed at helping policyholders offset the costs of medical treatment by covering a portion of the professional and hospital fees incurred. According to the U.S. government's health insurance exchange website healthcare.gov, this type of coverage comes in several forms designed to meet the varying needs of the insured. Health insurance plans are also offered in 4 categories based on how the costs are split between the policyholder and the insurer. These are bronze, silver, gold, and platinum, which are also referred to as the metal tiers. The example above is for the American healthcare system. Many countries have different types of coverages that are part of a single-payer healthcare system or universal coverage depending on where you live. Your health insurance needs can vary widely depending on your country. Often confused with health insurance, life insurance plans provide a tax-free lump sum payment to the policyholder's family after they die. Coverage comes in different types but generally falls into 2 categories, with each type offering different levels of protection. This type of policy covers the insured for a set term. It pays out a stated amount called a death benefit if the policyholder dies within a specified period. This means they can only access the payment in the years that the plan is active. Permanent life insurance. Unlike term life insurance, a permanent policy does not expire. Coverage is available in 2 main types, which combine the death benefit with a savings component. A life insurance policy covers almost all types of death, including those due to natural and accidental causes, suicide, and homicide. Most policies, however, include a suicide clause, which voids the coverage if the policyholder dies by suicide within a specific period, usually 2 years after the start of the policy date. By now, it should be clear how important insurance is in protecting people and businesses financially. Having the proper coverage can help policyholders recover faster from unforeseen accidents and calamities by providing the monetary means to rebuild their lives. But one of the biggest benefits of taking out insurance is having the peace of mind of knowing no matter what happens, you are financially protected. Insurance plays a vital role in the lives of individuals, businesses, and various entities by ensuring protection against unforeseen events and uncertainty. With a primary objective to safeguard policyholders from substantial financial hardships, insurance acts as a safety net, effectively managing and reducing risks. Should covered losses occur, insurance companies fulfill their commitments by promptly paying claims, enabling policyholders to recover or replace their valuable assets. Insurance assures them of having reliable fallback options during challenging times. What risks are not covered by insurance? Insurance policies typically do not provide coverage for damages resulting from fraud, negligence, normal wear and tear, pre-existing illnesses, conflicts, or nuclear injuries. Intentional damages caused by the insured or any other malicious behavior are not included in insurance coverage. The normal usage and aging of insured assets, such as machinery or motors, are usually no longer covered. Damages arising from acts of war, terrorism, or nuclear accidents are generally no longer covered by insurance regulations. Losses that occur outside the geographical scope or time period specified in the policy may also not be insured. To avoid confusion during the claims process, policyholders should thoroughly read their policies and become familiar with the listed exclusions. While insurance is essential for protecting against various risks, these exclusions are necessary to maintain the integrity of insurance and prevent misuse of coverage. Who bears risk in insurance? In the realm of insurance, the transfer of risk goes from the policyholder to the insurance company. The insurance company assumes the responsibility of compensating for losses as outlined in the policy's terms and conditions. When individuals or businesses purchase insurance coverage, they enter into an agreement with the insurance company. This agreement stipulates that the policyholder will make regular premium payments in exchange for the coverage provided by the insurance policy. By doing so, the policyholder transfers the financial risk associated with specific activities or events to the insurance provider. Upon accepting the policyholder's premium payments, the insurer takes on the responsibility of reimbursing the policyholder for covered losses. The insurance company pools the premiums collected from multiple policyholders to create a fund that can be utilized to pay out claims when necessary. This mechanism of sharing risk is crucial in the insurance industry. It allows individuals and businesses to safeguard themselves against potential financial hardships resulting from unforeseen events such as accidents, natural disasters, and health issues. Without insurance, individuals would bear the entire burden of economic losses, potentially leading to significant financial strain and difficulties in recovery. To conclude, insurance companies assume the risk by providing financial protection and reimbursement to policyholders in the event of covered events. This transfer of risk mechanism offers policyholders the support they need to navigate uncertainty and recover from losses.